They built a glass paradise way too high, then the bubble pop. The silent sound of foreclosure signs are all over town. I got a bad loan, a promise they believe. Now the dream is over, they're feeling deceived. I watch from the sidelines, patient and cool, playing by a different set of rules. All I wanna do is and I will do is take the window. All I wanna do is and I'll cash out hard and watch the funds grow. This is straight up capitalism, chick, chick, boom. Sweeping up the pieces with the concrete boom. When I do, when I do, when I do. Get a call from my contact, a whisper on the phone. Another empty unit, the speculator is gone. He says a shame with a crocodile tears. He sells me their future for a fraction of last year. The paperwork's easy, a cash only deal. That heartbreak and panic is my next big steal. They get a cardboard box, I get the ocean view. It's nothing personal, it's just what I do. And a casual body, take your condo. And a casual body, and watch the fence grow. This is straight up capitalism, chick, chick, boom. Sweeping up the pieces with the concrete boom. When I do, when I do, when I do. Some myself ask for a quick return. Some I rent out, let the lesson burn. They call it a crisis, I call it a sale. In this concrete jungle, the strongest prevail. No funny business, I am the business. They sold you a lead, now I'm the witness. Seek your condo. Seek your condo. Watch the funds grow.
Happy Thursday, Miami. This is Condo Capitalism. It is a podcast, one hour podcast about what's going on in the South Florida condo market, especially from a distress perspective. We do this podcast every Thursday. We're going to be talking about various issues that pertain to those people who are into the distressed real estate market, whether it be a foreclosure, it'd be a short sale. Yep, we're talking about short sales again. And or it'd be looking for somebody to try to cut bait, get out, because they simply can't afford the high maintenance fees, the hefty special assessments, as well as the insurance. Who could forget about the insurance? What are we going to be talking about this week on the podcast? We are going to be talking about an announcement that just came out from President Donald Trump, in which he wants to ban large investors from buying single-family houses. Now, what does it have to do with distress? What is the repercussions? Why do we really care? Well, one thing leads to another, and one of the critical elements of what ultimately goes on in the real estate market is supply and demand. There's a bunch of institutional investors, and we're going to get into some of them, that are controlling a large chunk of houses. And they turn around and they rent these houses, and ultimately they have the ability to sort of control the market, just like a corporate owner, but a little bit different. Some people don't want to live in an apartment building. Maybe they want to live in a single family house. So what these groups have done, and they began back in and around the Great Recession, and they've accumulated, and now we gotten to the point where some are arguing that it's impacting pricing. These groups are basically controlling single-family houses, and as a result of that, people don't have anywhere to buy. Therefore, they're being forced to either buy a condo, which as we all know down here in South Florida, prices spiked in 2021 once the pandemic was sort of evolving. It was working its way through the system, and you didn't have to wear a mask in Florida, and corporations allowed you to work from home. So what we saw is a huge surge in condos. Now, why do people buy condos? Some would argue because there were no single-family houses available. Why weren't there any single-family houses available? Because the large entities, these Blackstones of the world, they were controlling large portfolios. So that's kind of the argument President Trump has announced this week. He wants to make housing more affordable. And how's he going to do that? By banning large institutional funds, groups, entities from buying single-family houses and basically returning it to some sort of normalcy. All kinds of details to get into it this week. And I should probably tell you that Jack McCabe, somebody I promoted in terms of being on this podcast, he's coming. Jack is coming. Jack will be joining us sometime in midstream. And once he does, we're going to get into some of the other details. But in the meantime, let me sort of give you an overview, but more importantly, I should probably start with who I am and what I do. My name is Peter Zalewski. I'm a condo consultant. I'm an expert witness. I'm also founder of the Miami Condo Investing Club. And I had the pleasure of working with some of these large institutional groups back in the day during the Great Recession when they were actually putting together the model. Now, I will tell you, this model, it started vertically originally. It was going to be condos. It was going to be distressed condos. That's when there were widespread condos all readily available in the South Florida area. And these institutional groups, these Wall Street funds, they missed out on the game. Why? Because foreign nationals were coming in. They were buying deeply discounted condos at cheap prices, and they were able to blow the model, the requirements, the criteria by these Wall Street funds. And what were the criteria? What was the general model? The general model was to go ahead and buy a supermajority of a building, or at least a majority of a building. Let's call it 51% of a building. They could then put in place their own engineer, their property management company. They would have control of the association, and therefore they can make the decisions they wanted to, and they could run these condos as if they were rentals. Once the market turned, they could turn around and offload them. But something happened along the way. The U.S. dollar free fell. The euro went up. All the foreign currencies went up, and we had deep condo discounts. And because of the deep condo discounts, foreign nationals came in. They picked up these units dramatically discounted. And you say, well, what's a dramatic discount? Well, you had retail condos that were trading, rock star type of condos. I call them A, maybe A minus. And they were trading for about $200 a foot. Some were even less than $200 a foot. If any of you know the greater downtown Miami area, there's an area called Wynwood. There is a condo project there in which it traded for about $80 a square foot. How do I know that? Because we made an offer of $40 a square foot. Ultimately traded $80 a foot. A couple years back, I saw, and there were some units for sale. You know where they turned to get? $700 a square foot. But anyways, go back to the Great Recession. Wall Street comes in. Blackstone is a group that I had some contact with at the time. They took a run at a project right across from Bayside Marketplace, right on Biscayne Boulevard. They lost out on it, and after they did, shortly thereafter, what they did is they tipped the model, and they took it what should have been vertical. It should have been all integrated. There should have been efficiencies. Remember, you got an engineer, you got a property manager. You're able to run it as a rental until the market's ready. Then you can turn around and offload the units individually at dramatic discounts. Remember, units which were going for $600 a foot, $700 a foot, $800 a foot, they were trading south of $200 a square foot below replacement cost at the time. So the Blackstones of the world, what they did is they tipped the model. Instead of going vertical, they made it horizontal, and they went out to the western suburbs. They started picking up foreclosures. They were picking up in a big way, and they were willing to pay whatever it took because they had long-term staying power. Fast forward from where we were in 2009, 2010, and now we have a situation where these groups, and I will get into some of the details, these groups are the ones that are controlling it all. And the argument is, if these groups are forced to either liquidate and or they can't buy more, therefore, those groups that own, who are they going to sell to? They're going to have to sell them one off. And that's the last damn thing they want to do. They want to move them in pieces, in chunks, in tonnage, if you will. So this is what's sort of creating an uproar. And everybody's asking, is this ultimately going to be the top of the housing market? Our price is going to have to fall. Why? Because if these groups open the spigot and they start releasing more product into a market in South Florida, where the condo market is in a deteriorating buyer's market, more than 12 months of supply based on December of 2025 numbers for the Tri-County area of Miami-Dade, Broward, Palm Beach County. What's that going to do to pricing? Pricing's already pulling back. Sales are down, depending on which market you're looking at. Some of them are flat. And how does this all factor in? And given the fact that we might potentially be having lower mortgage rates, it hasn't happened yet. Federal Reserve Chairman Jerome Powell, he's cut rates 3 times since September. Mortgage rates have moved minimally. They're still north of a 6 handle, still 6.1 something. Many investors say it's got to begin with a 4 handle. Until mortgage rates are at 4%, why am I going to get off my couch? So these are the issues we're dealing with right now. These are some of the I guess the topics that are going to be of great conversation as we go into and get deep into 2026. Why? Because there's all kinds of uncertainty about the housing market. There's concerns about affordability. What about the immigration policy? What about people who have been deported and or self-deported? Who's renting their places, for instance? What about some of the people losing their jobs? Are they going to be able to have these rock star places, or are they going to move in with friends? Are they going to get roommates that can do things like that? So we have all kinds of changes going on, and that's what I want to discuss with Jack McCabe when he joins us. Should be sometime soon. He told me roughly about 4:30 or so. We started this podcast about 4:15, 4:20, somewhere right in there. We were supposed to start at 4, but I was running a little bit late trying to put together everything. So let me get into the big picture, and then when Jack joins us, he's going to go ahead and fill in some of the details. So I am going to share my screen. I prepared something in advance, and we're going to be able to go through it. And then when Jack joins us, we go and we just keep running. So let me go ahead and begin sharing my screen, and I'm going to pull up a chart or a series of charts and images that I put together. So here's where we go. We're recording this on the 8th of January, as you can see. I'm going to scroll down a little bit. And this is a story that came out. The story came out about, what was it, yesterday? Yesterday or 2 days ago? Here we go, the 7th. Today is the 8th, so it came out yesterday. Boy, the days are just, they seem like so long ago because of all the dramatic changes going on. But Reuters reports, and their headline is Trump threatens to ban Wall Street investments in single-family houses. And what you should know is these groups go in there, they buy single-family houses on a one-off basis, whether they're in foreclosure or whatever the case may be. They have the cash to buy them, or they have the cash in order to take them down without financing. They'll typically buy them, then maybe they'll put some debt on it after the fact. Or what they increasingly were doing, they were going directly to home builders. Any of you don't know, Lennar is a big home builder based in Miami, based out there in the Doral area, just south of Miami International Airport. I'm not saying they're one of the ones who were selling these massive developments and partitioning and carving out some of their developments and simply dumping them off to some of these groups, but it's something to ask yourself about, and that's what Wall Street's trying to figure out right now. So you can see from the headline from Reuters, Trump threatens to ban Wall Street investments in single-family houses. Three critical points that Reuters pulls out. This is Wall Street is blamed for reduced housing supply and rent inflation. Why? Because the groups that own this typically are like REITs. And if they're a REIT, what do they have to do? They have to pay a dividend to shareholders. That's why people are investing it. So the money comes in, the fund or the REIT takes it. They go ahead, they acquire. They have to run it efficiently. And they also have to return something to shareholders. And what they return is your increased rent, generally speaking. Point number 2 from Reuters, home builders share drops sharply in Trump's comments. Yes, we saw some dramatic pullbacks in stock prices yesterday for these groups that are related to this market. I think they're calling it the single-family rental market, single-family home rental market, or rental homes, somewhere in there. It'll get spliced out. It'll get figured out. And then finally, a third point is Trump faces pressure over cost of living ahead of midterms. Remember, in November, we're going to have the midterm elections. The House of Representatives could be in play, as potentially even the Senate. And there's a lot of uncertainty right now. And one of the big issues people have is affordability. President Trump ran on this model of making things affordable. He was going to bring down prices, things like that. And I don't think everybody necessarily agrees with it. From an inflation perspective, inflation got it as low as 2.3%. Now it's north of 3%. We don't know what the exact number is. Why? Because the government was shut down for 40-something days. And as a result of that, some data is missing. So as we get deep into 2026, hopefully we've got a better sense on inflation. But what is the goal of the Federal Reserve for inflation? They want 2%. What is that now? 3% and rising. So these are issues that we need to factor in. We also have a job market that's starting to soften, and this is also creating additional uncertainty. So the Fed's jammed up. They're in two places. Their goals are, their mandates are two. One, they got to keep inflation. What they've said is 2% or less. Now it's north of 3%. It got as low as 2.3, but now it's gone back up. Some would argue maybe because of tariffs. The other aspect is they want ultimate job growth or ultimate employment, extreme employment. Basically, anybody who wants a job, they want them to have it. And what we're seeing is a slowing job market. The way they're referring to it is a low hire, low fire market, meaning if somebody leaves, the company's probably not replacing them. They might not be going out and just firing people, but they are not replacing them because they don't know what the predictability is. They can't necessarily forecast going forward as to what's going to happen. Why? Tariffs. Because of other issues involved with it. The stock market is roaring, a rip-roaring high. The rest of the economy, some would argue, is a little bit more challenged. So these are some of the issues President Trump and the Republicans are thinking about as we get into 2026. We have midterm elections coming up in November, so this is obviously a move to try to adjust one of the issues, which is affordability. And what's a big force of aspect of affordability? It's going to be energy, and it's also going to be housing. We all know what happened this weekend when the U.S. went in. They snatched the president of Venezuela, Nicolas Maduro. They captured him. They brought him to the United States. He's now on trial. And President Trump says we're going to be running Venezuela, and I guess that means oil. And we're going to be extracting oil or involved with taking the oil, and therefore you should see fuel prices come down. Oil's currently under about $60 a barrel. A lot of these companies I've heard and read, and oil's not my thing. Typically $65 a barrel is break even, and now it's south of 60. So we'll have to see how all that plays out. So let me continue onward. Now we got a story that came from CNBC. It says why Trump is going after institutional home buyers. They dominate markets like Atlanta and Jacksonville. Well, if you stick around long enough, I'm going to show you the list. We're going to name names, not only in terms of total single-family houses under control of these large groups, but also in terms of percentage, the share of the overall market that these institutional groups that own. And where's it all coming from? It's coming from the GAO, General Accountability Office. Excuse me, I have to cough. The General Accountability Office for, I think it's accountability, maybe it's accounting. One of the two. It's called GAO. They came out a report, and the report came out in last summer. Well, summer of 24, and that's what a lot of this is based on. So everybody's talking about numbers. What's going on? What are the markets? Well, there's a federal government report that's out, and we got it, and we grabbed some images. We did some screenshots. We also pulled some of the data. We put it together in tables. So you're going to be able to understand real clear what's going on in Florida, what's going on in other markets. Like, in Florida, you got Orlando, you got Tampa, you got Jacksonville, and you got Miami. Some of the other markets that are impacted by this, Atlanta. Atlanta's got a huge chunk of institutional buyers that are controlling single-family houses there. Another market, too, is going to be Seattle, Phoenix. All these markets, primarily in the Sun Belt. There are a couple exceptions, but most of them are down in the Sun Belt. I'd say Texas, Vegas, and then most of it's out in the Southeast. So according to CNBC Piece, it says one of the key points is institutional investors own about roughly 2% of the nation's single-family rental housing stock, but their presence is far more concentrated in parts of the Southeast. Yes, when we show you the map, you're going to see, while it's 2% of the national, it's a large chunk when you get into markets like Miami, like Orlando, like Dallas, like Houston, places like that, all of the growth areas rather than the areas that are kind of slow growth or no growth. So that's something to stick around for, and we will show you that chart. Second point that came out of CNBC story says large investors control about a quarter of Atlanta's single-family rental market, more than a fifth of Jacksonville's, and a sizable share in Charlotte and Tampa, as well as Miami, as well as Orlando. So what does that mean? That means one group or a few groups can control the stuff. They can control the spigot. They can either add or they can pull back. Think OPEC. That's sort of the concept. Now, OPEC's a little bit different, but that's the idea. A couple of people can make a decision, and therefore you can impact housing. What other decision can they make? They can make a decision to sell. They can make a decision to offload. They can make a decision to exit. And when they do, suddenly you got this, I'm not going to say a tidal wave, but you could have a surge of housing come on the market, much like we saw during the Great Recession, when you had bank foreclosures going on, you had banks trying to unload what they call real estate owned, or REO. So that's something we'll get into, and this is one of the issues. And by the way, next Thursday, I'm going to be having another podcast, and who are we going to be talking to? We're going to be talking to a gentleman who's actually dealing with the Blackstones of the world. They were dealing directly and selling to these funds who were picking up properties at deep discounts during the Great Recession. This is a time when these groups would come in from Wall Street. They would hit up all the investor clubs, and then they would, my words, not his, they'd say, bring us everything you got and we will buy it. And so next Thursday at 4 o'clock, we're going to be discussing it with somebody who's actually there and selling product to these funds, which are now in the crosshairs, if you will, under President Trump's potential ban, if you will. So let me continue on down with my chart. You see a nice picture of our president, President Trump, who made the announcement. A couple of points that came out, and this is coming from Reuters. Reuters has this chart. They put it together. It says small investors own about 87% of investor-held single-family homes in the United States. So it doesn't seem big in terms of what the institutional groups have, but where do they own them? They own them in the key markets. That's the part that's getting lost, and all these stories are coming out. They're talking about the big picture, but if you look at key markets that really had rapid appreciation, where are they? That's where all the institutional groups are owning. Now, going back to this chart from Reuters, it says President Donald Trump said he will take steps to ban large institutional investors from owning single-family homes to address affordability. And then they show a chart, and the chart basically says the percentage of homes owned by investors. Those investors own one to five homes. It's going to represent about 14.5 million homes. 6 to 10 homes, about 653,000. If you look at 11 to 50 homes, that'll come in at 753,000. And when it's 1,000 homes or more, it's coming in at 345,000. So the argument's being made here that, well, the institutional groups, they don't really have anything when you take it to the overall average. So it's not really that big of a deal. However, if you're out there playing in the real estate market, you're trying to buy a single family home, you've run into some serious issues. And one of the issues is pricing. And why is the pricing so high? Because there's nothing available. Why is there nothing available? Because large groups like this have taken it down. They control it. They have their portfolio. They have the economies of scale. They put an engineer, which is like a maintenance guy, in the area who could service it. Maybe they take out insurance, if any of the appliances break, all that type of stuff. So that's basically what they're doing in the suburbs, especially in South Florida. When you're east of Interstate 95, you're talking primarily condos. These are investors based on condos. Where a lot of this product is going to be, I would almost argue it'd be west of the Turnpike. For the most part of South Florida, if you're in Miami-Dade County, it's probably going to be west of the Palmetto, just to give you some sort of context. And again, when single-family home developers go to build up stuff, what they typically do is they carve out pieces of a large of a track, and they'll carve it out and they'll throw it out to different groups. So so it's not all monochrome. So some of the groups buying are in fact these funds. So according to this, about 345,000 homes are owned by these large institutional groups that own 1,000 homes or more. And then here's a chart. This is actually a little bit of foreshadowing what's going to come from the GAO report. That's the report where it's actually going to name names. It's going to give you numbers. It's going to go through all that. And what we can see here from this chart is national home price average. If you guys take a look, when we were in 2021. This is when, if you can see it, this is when September 11th happened. After that, Alan Greenspan, the Federal Reserve Chairman at the time, cut interest rates to zero. That basically spurred a bunch of investment. We had President George W. Bush. He wanted everybody to own a home. Because of the combination of all that, we really started to see a boom. We had a tremendous boom that ultimately led to what would be robo-signing, foreclosure crisis, all of the fun and games that occurred. And right when it was all going sideways, as prices were pulling back, that's when Wall Street moved in and start, dipping their toe or wetting their beak. And they just continued to grow and grow and grow. I still remember when I was dealing with some of these guys, probably was, I'd say late 2010, early 2010, somewhere right in there. And if you looked at our great South Florida condo boom and bust, it started in 2002, right after interest rates were cut to zero by Alan Greenspan because of 9/11 and the reaction to that in terms of keeping the stock market and the economy going. And it peaked in 2006 in terms of transactions. Pricing peaked in 2007. Ultimately, transactions bottomed in 2008, and pricing didn't bottom until 2010. So these Wall Street groups, they were coming in right in there about 2010, right as it was bottoming. And who knows? Maybe there's some of the investors that backstopped, that put in the bottom because they suddenly were acquiring things because prices were continue to fall and fall and fall. So something to keep in mind. So basically, we've been on a run since about 2011. You can see here. We had this run up as I was describing. Then we started the free fall. This is going to be a national. South Florida is a little bit ahead of the curve. We went through our booms and busts much quicker. We tended to go first, if you will. Just like California goes first on certain issues, we go first on, I would argue, especially on the condo market. Why? Because we have an international community. We have people from all over the world, and we have a lot of people who come here to sort of develop. So you might go to Silicon Valley because you are a technology person. If you're a condo person, you want to play in the United States, you're probably coming here to Miami because you can tap into all different aspects of the marketplace. We see as we follow along this chart. I was saying about 2010 or so is when I first got contacted. These groups are going around trying to buy, and then they were increasing. 2020 is the pandemic. It hits, and then we just see this surge, this spike in the national home price. So we'll continue onward. Again, this is coming from the GAO. Next one is the U.S. rentership rate from 2000 to 2023. So we can see here, the rentership rate, it went down. Why? Because President Bush, George W. Bush, he wanted us to have everybody have a home. And that led to everything that led to, I would argue, everything that ultimately led to what would turn into the Great Recession in the robo-signing controversy. And you can see here, the rentership rate has just gone up and up and up. A lot of people here, they were turned into renters because they lost their homes. They had over leverage. They bought 1, 2, 3, 4, 5, 10 different condos or houses, and everybody was getting their hands on cash, and they were flipping it and this and that and that. So everybody became a renter. Then suddenly, right as the pandemic hit, many people, I guess, started buying because interest rates were effectively zero. So it was cheap to get in. That first year of the pandemic, 2020, remember, it hit about March. I'll never forget because the Super Bowl's here in Miami. Patrick Mahomes, the Kansas City Chiefs, they won the Super Bowl. And then a week or two later, all of a sudden, a pandemic broke and kind of the world stopped, if you will. And you can see that reflected here in 2020. in terms of the rentership rate when people started buying or they moved in with family. And then it's since gone back up as prices have gone up. So let me get to some of the companies that are, and you should pay attention to if you want to know who's doing what. Before I do that, let me go ahead and check and see where Jack is, because it's a little bit into it. I don't see him yet. Okay, he's not here. Let me send him a quick message. Are you having problems, Jack? All right, so I sent Jack a message. We'll see where he's joining us. So let's get back to three of the big companies probably to watch if, in fact, there is this move by President Trump. Invitation Homes. Invitation Homes is a group that went around. They acquired a bunch of these, and now they're traded. It's publicly traded. And let's see what we have here. This was today's stock movement. I took a screenshot of this at 331. It was actually up slightly, but it was down from yesterday. It opened at 26. Oh no, look, it's actually, it's up. What did it close at yesterday? I guess that would have been the closing. 52-week high is 35 and 52-week low is 25.29. So definitely on the wrong side of that overall 52-week range. But Invitation Homes, that's one for you to pay attention to. What's another one? American Homes for Rent. American Homes for Rent, that's another one to keep an eye on. They're actively involved in this particular thing. When I took these screenshots, I should have taken a 5-day glimpse rather than a 1-day glimpse. They would have been able to give us some sort of comparison, but that's something to keep in mind. Now, on this American Homes for Rent, a 52-week high is 39.49, and the low is 28.84. Now, I would venture to guess the lows were hit yesterday. That would just be my guess, but it all fluctuates. And then finally, the third big one is going to be Blackstone. They had a report on Bloomberg today talking about how a lot of people are getting confused Blackstone and BlackRock. And I got to admit, it's pretty easy to get confused. The name, I don't know if done intentionally, unintentionally, whatever. It does get confusing, but Blackstone is the one that's going to be impacted by the housing. I don't think BlackRock is, but that's what the Bloomberg story. It was a TV report. I was listening on the audio, and they were discussing that. So Blackstone, American Homes for Rent, as well as Invitation Homes. Those are the ones to be watching for, to be to gauging, if you will, in terms of what's going on in this marketplace. So we're going to continue on, and this is a copy of the GAO. This is the opening page of it. Remember, and I got it right the first time. I said Government Accountability Office, and that's in fact what it was. Government Accountability Office. They came out with this report in May of 2024. It's called Rental Housing Information and Institutional Investment in Single-Family Home. That basically means Wall Street buying single-family homes and renting them out and jacking up the rents and restricting or limiting, simply because of supply demand, what individuals who maybe are looking for a home, looking to step up, what kind of options they have. And the report came out in 2024. If you want to check it out, I do show you the URL as we go a little bit farther down. So I'll get into that shortly. Now let's take a look at the highlight. This is effectively the executive summary of the report, and it says large institutional investors emerged in the wake of the 2007-2009 financial crisis. Remember, like I was telling you, bulk purchasing foreclosed homes at auction and converting them into rental housing. Aided by access to capital through various sources, institutional investors had a funding advantage over smaller investors. Yeah, they had the cash. The other people didn't. There's Jack McCabe.
Hello, Peter.
Hey. What's going on, Mr. McCabe?
Hey, give me just 1 second. I'll be right back, okay?
All right.
I just wanted to let you know I'm here, so I'll be right back.
All right, Jack. Yep, Jack's going to be joining us shortly. Until he does, let me go ahead and continue onward. So this is, again, executive summary from the GAO report, rental housing. And as I was saying, these institutional groups, they were aided by access to capital through various sources. Institutional investors had funding advantages over small investors at the time when mortgage lending was generally nothing. It was challenging to get your hands on it, and that's why Wall Street had the opportunity to come in here. And let me just show you a quick glimpse of the chart before we go to Jack, so everybody gets a sense. And don't worry, I have a bigger version of this chart. We also went to the extent of putting together the numbers. So you're going to be able to see the total unit count in terms of single-family houses in all these Sunbelt markets, as well as the share of the single-family housing market according to the Government Accountability Office. So let me go ahead and bring Jack on. Jack McCabe, how's it going?
Peter, good. I apologize for being late.
No, Jack, what are you talking about? Thank you for jumping on. This is kind of how it works. I used to do print journalism. I didn't really do TV before, and they always say on TV, well, it's live, and you just don't know how it's going to go. Well, now I get a sort of a sense of how it goes.
Oh boy. So how are you?
I'm doing well. I'm doing well. I was just catching everybody up with some of the headlines that had came out. We went through some of the details. I was talking about the three publicly traded, I guess, stocks, if you want to call them, like institutional, American Homes for Rent, Blackstone, and then Invitation Homes. So we were just talking about that, and now getting to the GAO report, Jack. I actually pulled a copy of it. So I got some of the tidbits we can kind of throw out there, and then I can ask you to, provide feedback, input, all that type of stuff. But I guess my general first question to you is, what did you think when President Trump announced he's going to ban institutional investors from buying more single-family houses? I mean, Jack, you advise Wall Street. You've been advising Wall Street forever and ever and ever. What's your reaction to this?
Well, I consulted with Blackstone. By the way, Blackstone owns Invitation.
Okay, I thought so, but I don't want to misspeak.
Yeah, there used to be many, but Colony Capital and Blackstone bought up many of the groups that were putting together portfolios of foreclosures and for rent homes. First off, I thought, well, that's one of the two good things that I've heard him say he was going to do. Second off, I thought, how is he going to do that? How do you ban companies from transacting business in a free capitalist society? So
that's right.
All I can think of is that he's going to use his tariff mentality, and he's going to tax them maybe $50,000 or something if it's an institutional investor buying a private home. I don't know how else I don't think you can ban them. How can you ban them? So it's good news because prior to the downturn, prior to the Great Recession, investors in single-family homes and condos were primarily individuals. Or they were a couple of guys that got together and they managed their own portfolios. They, interviewed everybody that was going to rent from them, and it was either a sideline or it became their primary business. But you didn't have these big corporations and hedge funds and private equity groups, institutional investors that were involved in it because they saw it as too much hassle. It just was not easy to do because they were so spread out, and it didn't give the returns that they were used to from involvement in other industries. Then we had all of these foreclosures, and so you could go in and to a bank and you could buy 30 homes in a particular neighborhood. Made it much easier for them to manage and operate. And we've seen it progress through the years. First, they were buying on the cheap. Then even when prices were going up, they started paying above list price for different homes. And then we saw where they kept a lot of homes empty. And everybody said, why are they doing that? Well, it's because they wanted to manipulate pricing and keep those homes off the market and drive those prices up. Now we're in a different scenario. So it'll be interesting to see how Trump thinks he can go about this, how long it will take to happen. But if it does, it's great news for individuals and private investors again. And I think it's great opportunity as well for maybe putting together groups of private investors to go after these properties, because by and large, a lot of people would like to be involved without being involved in the management and the day-to-day operation. So if they can find somebody who's qualified, who can take care of all that for them, do all the accounting work, sell when it makes sense, it's a great investment for them. Because in many cases, these properties, they could double or triple in 3 to 5 years' time. It's hard to get those type of returns in any other industry.
So Jack, let me follow up on that. So for them to double or triple, I'm assuming they're going to have to come down first.
Oh,
or
yeah.
are you saying they're going to? And okay, so walk me through it. Let's just say President Trump was able to come up with a policy. He announces this tariff concept like you're talking about. And so what does Wall Street do? They try to move them in bulk, but if you're banned from buying them in bulk, so then you have to sell them one off, or how can you envision it playing out, and what kind of discount?
I don't think he's saying that he's going to ban bulk sales, is he? He's just saying he's going to ban corporations from buying.
From buying, yeah. But I'm saying, but if you already own a portfolio and you need to unload it by a certain time, like remember everybody was rushing to get stuff to the United States before the tariffs kicked in? So I'm just wondering if you're looking to unload it in your Wall Street, who the hell do you unload it to? Do you, you know what I mean?
Well, to individual investors, you do it through auctions, or you do it with different small investment groups, none that are corporate or large in size, but smaller groups. And you may have direct sales, you may do it through an auction house, but they've made a lot of money off these homes already. And they have a lot more money that they can make. Even if they sell below market now, prices have gone up so much, they're still way above what they paid for it. Plus, they've had all the cash flow from the rental income. But now the insurance premiums are sky high. The homeowners association dues have gone up, and then, as we know, and you've talked about very often, the condo association dues and special assessments are knocking people out. And you've got condos that were selling previously a year and a half ago, even $450,000. You look at the tax records now; they're selling at 150 or 175. So,
and don't forget my buddy, Jack. Don't forget my buddy. He paid $30,000, and the seller was happy to let it go $30,000, even though it had a street value of $200,000. So yeah, what you're saying, get on.
It's like people that own timeshares. They're giving them away now. They're almost willing to give you money to pay for the first year's maintenance dues. Okay,
right?
They want to get out from under them. They have no value anymore.